The Federal Reserve just slashed interest rates. This decision is monumental and has far-reaching implications for the economy. This is a big deal. When the Fed cuts rates, it sends ripples through the financial world, affecting everything from stock markets to personal finances. Lower rates make it cheaper to borrow money. This means that loans for homes, cars, and businesses become more affordable, encouraging spending and investment. This can boost the economy. Businesses invest more in expansion, hire more employees, and increase production. Consumers with more disposable income are likely to spend more on goods and services. This rate cut is especially important now. The current economic climate is fraught with challenges, and the Fed's move aims to provide some relief. The economy is facing headwinds. From global supply chain disruptions to local business closures, the challenges are numerous and complex. Inflation is still a concern. Rising prices for everyday goods and services can erode purchasing power, making it harder for people to make ends meet. The war in Ukraine is causing uncertainty. Geopolitical tensions add another layer of complexity, affecting global markets and investor confidence. The Fed is trying to keep the economy from stalling. Lower rates impact everyone. Mortgages become cheaper, making it easier for people to buy homes and for existing homeowners to refinance. Car loans become more affordable. This can lead to an increase in car sales, benefiting the automotive industry and related sectors. Credit card interest rates may even drop. This can help consumers manage their debt more effectively, reducing financial stress. But there's a flip side. While borrowers benefit from lower rates, savers might not be as fortunate. Savers might earn less on their deposits. Lower interest rates mean lower returns on savings accounts and fixed income investments, which can be particularly challenging for retirees relying on interest income. The Fed's move is a signal. It indicates their commitment to supporting the economy and their readiness to take action when needed. They are worried about the economy. The rate cut reflects concerns about economic growth and stability and the need to stimulate activity. They are willing to act to keep it growing. The Fed's proactive stance aims to reassure markets and the public that they are monitoring the situation closely. This rate cut is just the beginning. Historically, the Fed has made multiple rate adjustments in response to economic conditions, and this could be the first of several cuts. More cuts could be coming. Analysts and economists will be watching closely, predicting future moves and their potential impacts on the economy. Historically, rate cuts have given the stock market a boost. Why? Lower rates make it cheaper for companies to borrow money. This can lead to higher profits. Investors love higher profits, but it's not always a straight line up. Sometimes rate cuts can signal a weakening economy. This can make investors nervous. The current situation is unique. We have high inflation. We have geopolitical uncertainty. The market's reaction to this rate cut is uncertain. One thing is for sure, volatility is likely. Fasten your seatbelts, investors. Let's talk about the economy. The labor market is still strong. Unemployment is low. People are spending money. This is good. But inflation is still a problem. Prices are rising too fast. This is eating into people's paychecks. The Fed is trying to get inflation under control. There are whispers of a recession. Some economists are worried the Fed's rate cut is a preemptive strike. They want to prevent a recession if possible. The economic picture is mixed. There are both positives and negatives. This is creating uncertainty in the markets. Rate cuts impact different sectors in different ways. Tech stocks, for example, are sensitive to interest rates. Why? Because tech companies often borrow heavily to fuel growth. Lower rates are good news for tech. Defensive sectors like consumer staples and utilities are less sensitive to interest rates. People still need to eat and keep the lights on, even in a recession. This rate cut could be a tailwind for tech stocks. But don't forget about defensive sectors. They offer stability in uncertain times. Remember, diversification is key. Don't put all your eggs in one basket. Section 5. Riding the Rate Cut Wave Investment Strategies. So, how should you invest in a rate-cutting cycle? First, don't panic. Stay calm and stick to your long-term plan. Second, consider adding to your stock positions. Lower rates could boost the market. Look for companies with strong earnings growth potential. Third, don't forget about bonds. While bond yields may fall, they still offer diversification. Consider adding high-quality bonds to your portfolio. Finally, stay informed. Keep an eye on the economic data. Listen to what the Fed is saying. Be prepared to adjust your portfolio as needed. Section 6. The inflation puzzle. A closer look. Inflation is the economic buzzword of the moment. It's the rate at which prices for goods and services rise, and it's been rising at an alarming rate. The Fed's rate cut is a delicate balancing act. They want to stimulate the economy without making inflation worse. It's a tough needle to thread. Some experts believe inflation has peaked. They point to falling energy prices as evidence. Others are not so sure. They worry that inflation is becoming entrenched. The Fed is watching inflation closely. Their future rate decisions will depend on whether inflation cools down. Section 7. The housing market conundrum. The housing market is another area impacted by interest rates. Lower rates usually lead to more home buying. Why? Because mortgages become more affordable, but the current housing market is complex. We have low inventory, we have high demand. This is keeping prices elevated. The Fed's rate cut could add fuel to the housing fire. This could make it even tougher for first-time homebuyers. The housing market is a key indicator to watch. It can tell us a lot about the overall health of the economy. Section 8. Consumer spending, the engine that drives the economy. Consumer spending is the lifeblood of the United States economy. It accounts for nearly 70% of the nation's GDP, making it a critical component of economic health. When consumers spend, businesses thrive. Retailers see higher sales, which leads to more hiring and investment. This creates a positive feedback loop that fuels further economic growth. Conversely, when consumers pull back, the economy slows. Businesses face declining revenues, which can lead to layoffs and reduced investment. This negative cycle can be challenging to break. The Federal Reserve often steps in to manage these cycles. The Fed's rate cut is designed to boost consumer spending by making borrowing cheaper. Lower interest rates make it more affordable for consumers to finance big-ticket items like cars and appliances. This can stimulate demand and help lift the economy. However, inflation is putting a damper on consumer spending. Rising prices for goods and services mean that consumers have less disposable income. People are feeling the pinch of higher prices. This can lead to reduced spending on non-essential items, further slowing economic growth. This could offset the positive impact of lower rates. While cheaper borrowing costs can encourage spending, high inflation can negate these benefits. The Fed is hoping that lower rates will outweigh the negative impact of inflation. They aim to strike a balance that will support economic growth without letting inflation spiral out of control. Only time will tell if their gamble pays off. The interplay between consumer spending, inflation, and interest rates is complex, and the outcome remains uncertain. Section 9. Global implications of rate cuts. The Fed's rate cut doesn't just impact the United States economy, it sends ripples throughout the global financial system. Other central banks often follow the Fed's lead. Lower rates in the United States can lead to a weaker dollar. This can make United States exports more competitive, but it can also lead to inflation in other countries. The global economy is interconnected. The Fed's actions have implications for businesses and investors around the world. It's important to stay informed about global economic developments. What happens in one part of the world can quickly impact other regions. Section 10. The long view, rate cuts, and the future. In this section, we delve into the implications of the Federal Reserve's decisions on interest rates and what it means for the economy moving forward. The Fed's rate cut is a short-term measure. It's a tool used to stimulate economic activity by making borrowing cheaper. It's designed to address the immediate challenges facing the economy, such as slowing growth or rising unemployment. By lowering rates, the Fed aims to encourage spending and investment. But what about the long term? The effects of rate cuts extend beyond the immediate future and can shape economic conditions for years to come. Continued rate cuts can have unintended consequences. While they can boost economic activity in the short term, they can also create risks. They can lead to asset bubbles. When borrowing is cheap, it can drive up prices in markets like real estate and stocks, creating bubbles that may eventually burst. They can inflate debt levels. Lower interest rates make it easier for consumers and businesses to take on more debt, which can become problematic if rates rise again. They can make it difficult for the Fed to raise rates in the future. Once rates are low, increasing them can slow down the economy, making it a challenging decision for policymakers. The Fed is walking a tightrope. They need to carefully balance the short-term need to support the economy with the long-term goal of maintaining financial stability. They need to balance short-term needs with long-term sustainability. This requires a nuanced approach and constant monitoring of economic indicators. It's important for investors to take a long-term perspective. While rate cuts can create opportunities, they also come with risks that need to be managed. Don't get caught up in the day-to-day noise. Market fluctuations are normal, and reacting to every change can lead to poor investment decisions. Focus on your investment goals and stay the course. By keeping a long-term view, you can navigate the ups and downs of the market and work towards achieving your financial objectives. Section 11. Navigating uncertainty, a prudent approach. The current economic environment is uncertain. We have inflation, we have geopolitical risks, we have a Fed that is trying uncertainty. It's important to be prudent. Don't take unnecessary risks. Focus on quality investments. Diversify your portfolio. Remember, investing is a marathon. Stay informed and stay invested. And always remember, bulls make money, bears make money, pigs get slaughtered.